Hi, welcome to session 4. This session is about planning, financial planning, and also budgets. This is part of the course on entrepreneurial finance. So, the first question that you might have is why do we need to do financial planning at all? Because a lot of things are uncertain, things maybe are difficult to forecast. How should I organize or think about the future growth of my company or organization? We should see this as planning as a function that helps us to be better prepared for the future, even if it's a very uncertain or unclear future. What we will also explain is that the budgeting, and in this case this is very important for startups or new projects, is part of this planning exercise. So to plan the future, and we know that the valuation of a company of a project is usually even more related to the future than even to the present. So to plan a future, we need to do forecasts. We need to assume things. We need to have expectations. As you might imagine, for every forecast, there will be someone that would not agree with your assumptions or your expectations. So this becomes more of an art than a science. So it will be very important that we justify why do we think that our assumptions make sense, what is the reasoning behind, what kind of evidence do we have to assume something like that, what is our reference model, all those aspects. So at the end you might feel like, okay, I've done a forecast, I've done a plan, but actually this will almost never happen. No? So we need them anyway, even if they are wrong. They help to create a reference set that helps us to move ahead and also to learn also how the market is behaving in relation to our expectations and so on. So this is important because when we say that we need to do then those forecasts, it doesn't mean that we will just try to do them whatever way, in whatever model. We will try to do our best, most accurate forecast based on the information we have, the assumptions that we have, and we will try to be transparent on what those steps that we take and what are those and how they work. So the objective that we have is that we are able to develop this projected income statement. So an income statement, a P&L, that shows the profit and losses that we expect to have in the next 3-5 years. Also after that, what we would also be able to do is to generate the balance sheet. But this becomes a bit more complex. So because here you need to start to connect the future earnings, the future changes in your receivables or liabilities with adjustments also in your balance sheet in the coming years. This is specifically helpful if you are in a situation where you see that your growth plan will require for additional funds, meaning that we'll need some help from investors or other stakeholders that bring in money to be able to achieve this growth. Also, what it's important that we manage to achieve here is that we try to have a reference of what will be the impact of some exogenous unexpected changes, a financial crisis, a natural disaster, something that can hit the business. This way we know what is the cushion that we have to be able to go through those difficult moments. At the end, what we want also is to have a tool to quantify the trade-off of some of those business decisions. So is it better to grow faster during the first years? Is it better to grow more carefully or more conservatively, but then maybe not have to ask for investors' money? So there are trade-offs in each of those different paths that you can pick. At the end, what we want when we do planning is that we want to prepare a bit better for that uncertain future. The idea that because it's uncertain, then we should not plan and just improvise, it's proven that it's not the best path. So we think, and we would strongly suggest that by trying to prepare and increase our preparedness, we will be able then to be better in those future scenarios. At the end, what we want is to translate this into our current decisions. So what should we be doing right now to be better, in a better position in a future situation? What we will do is we will be using an example in the next slides of a company that has had issues that it shows how difficult it is sometimes to forecast growth and depending on the market conditions or industry evolution. The company is Fitbit. take your time, stop the presentation or stop the video, and take some time to look at the years 2012, 13, 14, 15, and 16 of the company and how their sales were increasing. As you can see in the sales growth ratio, they were managing to keep some profit ratio, and they were even managing to have profits during some of the years. What is important when you look at this presentation or this slide in particular is that you get a feeling on how do the total sales or revenues get translated into a gross income. So what happens? So from the total sales revenues, there is a cost of goods sold, there is some expenses that they have to run into, and then there is some depreciation, and at the end we have the gross income. Look how much it changes from 2012 to 2016. Not only the number of the gross income that is also increasing in relation to also a big increase they were having at that time in sales, but also look that they have to start using more depreciation and amortization expenses. They also are getting much bigger, times bigger in R&D, in sales expenses, and other related expenses that are impacting on their ability to transform sales and revenues into profits. But if we were just looking at these years, we would say, okay, this is a company that is in a growth track. So we would expect 2017, 18, 19 to keep seeing this positive evolution. Again, take a moment here to see and answer the questions that are highlighted in the squares. So what is driving sales? Is the sale of the units that you see on the left, those smartwatches? What is driving the costs of goods sold? What do you see also as maybe the selling and general administrative costs? And then also, which of those expenses are related to sales and which not? Maybe the increase in sales will generate a similar increase in the R&D expenses? Yes, no. Will the increase in sales generate a similar also increase in maybe in other unusual expenses? Yes, no. So we would expect some of them are more directly related and some of them are more indirectly related. This is important to get the feeling on these relationships because this will help us then to build forecasts in the future. So what does it happen? What happens is that in the following year things don't go in that direction that we were expecting. The market is changing in 2018 and they actually see a drop in their sales revenue. For first time in the last years, instead of increasing, it's a drop of almost $500 million US. This has also a huge impact in their ability to generate profits. So what it's telling us is that they are not able to actually adjust or reorganize the company fast enough, and this drop in sales translates into also losses, an increase in losses. Again, take a moment, look at the relationships between the numbers and how they are shifting very quickly. So what was happening in this year? There was the specifics of the market. So the market was changing very rapidly. It was a moment where Apple was coming in, and even if some of the analysts were expecting that Fitbit had advantages over some of the competitor products, what we could see is that it was not going ahead in the expected way. You can look at those different news, for example, at the time where that people already felt that it was difficult for Fitbit to sustain their position and have a different offering that would help them in the future. When we look at those numbers, then it becomes more difficult to project. So if a company has had a sudden change of trajectory, how would it be then in the following year? Should we expect this to be just a bump on the road and then I should forecast growth again? Or no, I should assume that actually if the last year it dropped by 20%, the following year should drop also 20%. This becomes, as you are already perceiving, quite a challenge. So in this type of situations where the previous path is not valid anymore to make a forecast, it becomes quite complicated, and we need more information about the market, the behavior, what is going on, maybe new product launches or other things that might be influencing. So, and this also, I would suggest to stop a moment here. Now here you can see what actually happened with the company, what happened in the following years, what happened in 2018 and what happened in 2019. As you can see, the company didn't find a way to redress the trajectory and to find again the path for profitability. This challenge can be seen in that the sales and revenues didn't come back to the levels of 2016. And if you go down, for example, to the pre-tax income, the net income of the company before having the taxes, you can see that actually the losses increase, not decrease. The company was trying to find ways, but also at the same time that they were trying to find ways to sort out the situation, they were also incurring on expenses as some of their assets had to be depreciated because they were not generating those revenues that they were expecting to be generating, and they had less value. This can be seen, for example, in these unusual expenses that appear in 2018, or also the final results that come out from 2019. So this would be a case that it's quite complex to build a forecast on, but by looking at the relationships between the sales and the costs, we can see that some things have not changed in these last years, while some things were changing, depending on the total revenues. So at the end, what can we use to forecast sales? So if it's more an art than a science, then what can we use? So we can use historical data. We can use life cycle models. In the industry, the products have a life cycle, and it's usually companies are an aggregation, a portfolio of different products, and then we can see whether maybe some of their key products are reaching the end of the cycle. This happens a lot in pharmaceutical companies when the patents are kicking in. We can look growth cycles. So for example, like a product category is still gaining adoption and growing a lot. And then maybe we will see that the products that are there will keep growing as long as that category, in this case maybe it was the GPS watches, was a category that was still growing. So the case of Fitbit surprises a bit more. What is also an option is that, for example, if we are launching a new product in our portfolio, we can also look at the existing products that are being replaced and what pace of replacement do the consumers usually follow. This is the classic case, for example, of elevators in buildings. When they are launching a new model of elevator, they should not expect the next year that all buildings will change their elevator to get the new model. But in the following 10 years or 15 years, people or companies or building managers will be making decisions to change their elevators. And then this will be a moment of product replacement. We can also use market reports on overall growth and other elements that will help us to guide a bit this forecast. It makes no sense that we forecast at times higher growth than the overall market, because this means that then we are the market and we are times above the market. So things need to make sense and need to be properly calculated. There are other options to try to do this sales forecasting. For example, trying to look for, you're launching a new product in a new category, you try to look at maybe a customer surveys and you try to use some of that data. The challenge here, as we are also highlighting on the orange box, is that how much of that intention to purchase will be converted into actual purchases, and what type of indicators you can use to get better data on that. Because, as we know, not because they tell us that yes, I like the product and I'm happy to consider buying it, will mean that once the product is launched, that order will come in. Something that is different, and maybe those of you that are familiar with crowdfunding, you know that if you do a crowdfunding campaign, those orders are kind of binded. So once you are placing the pre-purchase order, you know that you will be able to deliver that product. That's why a lot of the Kickstarter or Indiegogo projects work very well against the classic customer surveys, because you are actually pre-selling your products. We also like to look at behavior of customers, also looking at their historical behavior. So any data that you have on shifts in behavior, data on how people maybe consume that type of product and how they use it and so on, this will help you to build that forecast. How often they replace a cell phone, how often they replace their bike or their car. These type of things will help us to build that forecast. At the end, what we want with these forecasts is to have our own cash budget. It's critical for a startup. When you are growing up, you need to know how much cash do you have, whether you have enough cash to survive the next months or not. And sometimes cash management becomes a priority. How do we generate cash inflows? Then it's through basically our operations. Any sales that are, especially if they are done in cash, they help us and contribute to those cash inflows. And also when we are able to collect from clients that they finally pay what they owe us. We can also raise funds. We can get debt or credit line, and we can also sell stock. Other options that we have is that we might be investing in financial assets, but that's quite unusual for a startup to use the money that they have or resources to invest in other companies' assets. However, we have a lot of outflows, and this is happening every month, every quarter, on payment of material, wages, anything that we need to keep the operations up in the startup. And we also have to pay some financing interests in obligations in debt, if we have to repurchase stock or shares or other things that we might have to do. We might have some financial obligations. And the same happens, we have also outflows when it comes to investing in our own equipment, when we want to buy new machines, new devices, or maybe acquire patent or something that can be helpful for us. So we have to be able to combine those two things, the cash inflow, cash outflows, and how much cash do we have available. What I'm talking about here is exactly the same that you might have to be doing at home when you plan your own personal cash management. How much money you have in the bank, what is coming in, what is coming out. Again, I would suggest stop. Take a moment to reflect. How do you plan your finances? Are you trying to always save and increase your cash position? Are you trying to match the inflows, outflows? Do you have a lot of unexpected outflows that break all your planning on the money that you wanted to save to acquire something bigger or to get that trip that you wanted to do, and so on? This will help also then that you can transfer the way that you manage your cash budgets also in the context of a firm or a project that you might have to manage. So the usual question is then, okay, then how do we make those two things mix together? And we will not go into detail. This requires a much more detailed overview and attention and even exercises on this. But basically what we do is that we have expenses that are happening at a monthly basis, and then we want to be able to aggregate those expenses and changes into the annual accounts. Just as an example that we have here with inventory. So what happens then? How is this translated into a day-to-day operations? What happens is that we are, let's say, in the month of January, and we have a beginning balance in the inventory. Maybe it's coming from December, maybe it's our starting inventory. During that month, we do purchases. We also have to pay wages because the inventory is being elaborated or produced. And then we are also selling part of this because we are selling some of our goods to the clients. And then we have an ending balance. That ending balance is what goes then to the month of February. And we go like this till the month of December, where the ending balance of December is the one that we have ready then for the following year, and is the one we use to close the amount on the balance sheet for that year. What is interesting here is also how does financial planning then relate to growth. So the whole story here is when we plan for the future, we are also able to see better what are our resources, what are our gaps, and how we then can prepare ourselves to respond to the future opportunities that we might be having. This opens a whole different topic that is about acquisitions and how we want to grow and develop in the future. Again, here I would recommend that you stop, the video and take a moment to follow this path step by step and different ways and approaches on how to develop your assets in relation to the plans that you have for growth. There is a reference here to a very interesting book by Kaplan and Mitchell that it's Build, Borrow or Buy, Solving the Growth Dilemma. It's a very good additional reading on the topic on how to build those assets that will fit with your financial plan. We have now a specific approach on the concept of profit planning. This is interesting for us because this takes a step forward. What we want to see is how do we move from the production cost to the potential profits. What are our production costs? And this is critical, especially for hardware startups that need to be very careful when they start to develop their first units, their first versions, and they need to be able then to scale when they go into full production, how those would be transferred and which things will change, which things will be similar. So what will be similar? Probably the direct costs. We need to be able to know whether the production, the materials that we are using make the product feasible, make the product possible in the future. Then we will have an indirect cost. All those indirect costs are the ones that we cannot allocate to each of the specific units we are producing. Usually it's maybe the people that are involved or working in the factory, they are working in many different units, and then we try to allocate them indirectly. Or some of the expenses to keep the factory running, they are allocated indirectly to all the products that have been produced in that period of time. So the whole concept of factory overheads, then it's open for discussion. How do I allocate them? Do I allocate them based on the number of units? Do I allocate them based on the total cost of those units? Do I allocate them based on maybe the number of hours that they've been used or the time it takes to produce? Depending on how I do this, I will have a different costing for each of the products when I add direct and indirect costs. And this will influence decisions in my portfolio. So this is not a trivial element. And this needs to be agreed with the production manager or with the colleague in the startup that is preparing the production setup. This will have an impact when we scale up the business. We need to understand very well those costs so that we make the right decisions when it comes to production in the future. An example of usually, and this is a table that is missing quite a few costs, but we can see this is a product like a watch, and here we can see the differences that are there depending on the type of component and the type of element. It has a different weight in the total final cost of the device. Here the whole story is that if you were the manager or the product manager in Apple, you would have to be careful on what type of costs do I want to keep under control, which ones I can be maybe looking for different suppliers, and in which cases some of the components or elements I want to manufacture myself so I keep that cost very well, even more under control. So the whole, this is just an example of, build of materials. Here, as you can see, there are missing costs on the human elements or the production time that are also important, that are not captured here. But it gives an indication on the importance of looking at the different components and elements behind the total cost of a product. So at the end, what we want to be able to understand more in this financial planning approach is that when we organize production, and here you can think again about the Fitbit case, which of them will be variable costs, which of them will be fixed costs, and which of them will be mixed, so that part of the cost is directly allocated or depends directly on the number of units I produce, and which of them are maybe that when I have to improve or increase production capacity, I need to change, move to maybe a bigger factory. And then it becomes what we call semi-variable, like steps costs. Here it's good, again, to pause the video and take a moment to draw this in a graph and try to imagine how is this happening, whether the relationship is one-to-one or whether there are some, the relationship is not completely direct. And the more I produce, I can be saving and spreading a bit more that fixed cost that I have in any case if my business is running. This will allow us again to do some calculations that are more related to production analysis and production costing, that we will not go that much in depth into it, but it's good to keep them in mind. So for example, we would like as managers in our startup or in a new project to know what is the contribution margin per unit, the selling price minus the variable cost for each of the units. We will also like to know the cost volume profit analysis, so that which sales are actually being transformed more likely into profits, and which products are driving this profit conversion in a better way than others. At the end, what we want to know is this risk and profit analysis. So the expected sales minus the break-even sales, and then how likely it is that we actually manage to turn a profit in the next semester or in the next year. This is something that in the case of Fitbit, you can see that it was shifting radically after the numbers of 2016, 2017. Then suddenly they moved into a scenario where the possibility of having profitable exercises or profitable years was getting slimmer and slimmer and slimmer. This is what actually brought the company to a situation where they basically tried to find a buyer for their whole business. This is what we wanted to cover in this session, to get a closer look at these financial planning aspects. Take your time, go back in the video, clarify doubts, and just keep moving. This is the end of this session on financial planning and budgets.